David R. Guttery is the president of Keystone Financial Group in Trussville, Alabama. David Guttery and Brandon Guttery are financial advisors and represent Emeritus Investment Company, LLC. Please stay tuned through the end of the video for additional important disclosure information.
Hello, clients and friends. This is the third of a continuing series of podcasts that we will host on an ongoing basis. For the time being, the goal is to produce these podcasts on a weekly basis as the COVID-19 situation remains fluid. Now look, the objective with these podcasts is to continue our observation of the economic impact to the response of the virus, continue to share our thoughts on current market conditions, as well as the opinions of the many economists and analysts and managers that we follow on a routine basis. And again, I want to encourage all of you to please share the links to these podcasts with anyone that you feel may also benefit from having the information that we're disseminating through this channel. So again, let's start with a market overview. Current as of the close of business on Wednesday, the 28th of April. The Dow Jones Industrial Average finished higher by almost 533 points with a value of 24,634 points. Now remember, the intraday low for the Dow Jones Industrial Average occurred on the 23rd of March with a value of 18,213 points. Now, only time will tell if this proves to be the market low for the event. Conversely, the previous market high was established on the 10th of February, and at that time the value was 29,379 points. So, from the February high water mark to the most recent intraday low water mark on the 23rd of March, the Dow Jones Industrial Average was down by 11,338 points, or 38%. Since that low point, as of the 29th of April, the market is higher by 6,421 points. Now that's a gain of 35.26% from the March intraday low. With yesterday's closing value of 24,634 points, we remain off the recent high levels by 4,917 points, or 16.64%. Let's talk about oil. This continues to be a story in the market. In our last podcast, we discussed the unprecedented performance of the May oil futures contract as it settled on Monday, the 20th of April, at negative $37.20 per barrel. Now, we also noted that on Tuesday, the 21st, that the same contract closed above a $14 per barrel price, and we talked about how odd were those price swings. Over the last week, we have seen oil markets stabilize noticeably. Again, referencing the website of the CME Group, we see that the October contract is trading at $27.09 per barrel. The November contract is at $28.11 per barrel, and the December contract is at $28.90 per barrel. Now, looking at even further, the March 2021 contract is trading at $30.87 per barrel, and the June 2021 contract is at $32.07 per barrel. So, when you look at the recent activity in the oil market, resulting from the actions taken by the Saudis early in April to produce at maximum capacity, and then the effects on demand from a global economic shutdown resulting from efforts to flatten the COVID-19 curve, I think that you can discern what the energy complex believes anyway about the future of economic conditions. Otherwise, I would expect to see weakness in prices far into the future. So legislatively, when we were recording the last podcast, Congress was preparing to approve the second wave of funding for the CARES Act. Since then, a second wave of $484 billion of funding for the CARES Act was approved and signed into law. That added $310 billion into the payroll protection plan to continue funding for that for that program. Now look, this is of critical importance because it is this funding that provides employers with the ability to retain employees and pay the employees or benefit from the retained employee credit of the CARES Act, but it also gives them the opportunity to furlough employees with pay or without, but in either case, it preserves their workforce and it leaves health care benefits intact for millions of employees. It is this funding measure that can help maintain consumption momentum and span the gap created by efforts to flatten the COVID-19 curve. So between the two tranches of funding, we are really only now at a point where we can begin to measure the efficacy of the program in the form of retained employees. So I would expect to see that reflected in future economic reports. Speaking of the economy, as we've discussed before, I think that we have seen the apex of COVID-19, the disease, in this country. Each state is observing their own curves, but on the whole, I believe that the data confirms that we're on the downside slope of the bell curve. Now, we have not seen the apex of bad economic information yet. However, we will likely see that apex of bad economic news over the next 30 to 45 days. Now, you've heard me suggest over the last few weeks that, in my opinion, that we would have the last of the historically bad weekly jobless claims report last Thursday with an increasingly better report beginning today. Well, as of Thursday morning, the 30th of April, first-time weekly jobless claims were reported at 3.839 million, according to the Labor Department. Now, there's no question that that is a historically bad number in and of itself. It is nonetheless 44% lower than the high water mark of 6.86 million claims that we saw on the 2nd of April, prior to the passage of the CARES Act. Furthermore, and this is impressive to me, the 4-week moving jobless claims average declined by 757,000 claims, or 13.07%, in just 1 week. That's a big declination between two reporting periods. And I think that this is due to the early impact of the PPP and other aspects of the CARES Act that are only now beginning to have a meaningful impact in the form of lower claims and continued salaries. So I believe that we'll see this trend gather momentum over the coming weeks. Also, I believe that workers that had been previously laid off are being and will continue to be recategorized as furloughed with or without pay, and thus we may see positive revisions to the previously historically bad jobless claims reports. It's possible that a good bit of the improvement in the 4-week moving jobless claims average is attributable to this fact alone. All right, now look, just again to prepare you, I believe that the Labor Department report on the 8th of May will likely be the worst that we'll see in this COVID-19 crisis. That report covers the survey period between the 12th of March and the 12th of April, and it was during this time when we saw most of the efforts to close restaurants and businesses that were deemed to be non-essential. It also included the period of time prior to the passage of the CARES Act, and thus before the PPP program, when employers were faced with few other options than to simply lay off employees. We may very well see an unemployment rate of negative 16% or higher, with payroll losses of 3.5 million or more. Just be ready for that. Furthermore, don't be surprised if the market is higher on that day and seems to shrug the number off. Remember what I've been telling you for weeks now. Markets are discounting mechanisms. The markets have already priced this number into themselves. So conversely, I believe that the Labor Department report that we receive on the 5th of June for the period covering the 12th of April through the 12th of May could be starkly positive and also carries sharply positive revisions along with it, as it reflects the period of time following the passage of the CARES Act and the cumulative $660 billion of money that will have been received by small business employers by that time to retain members of their workforce. On the GDP front, we learned this week that the advance read on first quarter GDP was down, negative 4.8% against expectations of a decline of negative 4%. All right, look, again, I believe that the market has moved past this point, so to me it's a red herring. The reports that we will observe over the coming months will be the ones that are most telling. And estimates vary widely as to the severity of the economic contraction. As we'll discuss in just a minute, the early moves toward reopening the economy are critical to the chances that we might see a short-lived contraction and a robust economic recovery by the fourth quarter. Lastly on this topic, you've heard me reference the Chinese manufacturing output in the past. In our last podcast, we talked about the Market Flash PMI Index, and that, like every other PMI index, readings above 50 indicate expansion, and readings below 50 indicate contraction. Last week, we observed that the February reading for Chinese manufacturing output stood at 35.7, which was a historically low number, and that the March reading had recovered to 52. Wow, that in and of itself is a historically positive move from just one reading to the next. Today, on the 30th of April, we observed that reading decline to 49.4. So while that number is just off what we would call expansion territory, it remains sharply higher than the reading from just 2 months ago, and it's indicative of the sustained resurgence of manufacturing activity in the COVID-19 epicenter country. Remember, markets had initially assumed much worst-case scenarios within low valuations of just 1 month ago. This is the kind of evidence of actual results being better than worst-case assumptions that is behind the 35% rally from the March 23rd intraday low. So speaking of COVID-19, again, we've talked a lot about data in previous conference calls, so I'm not going to rehash that, but I do just want to briefly observe where we are in the U.S. As of Thursday morning, the 30th of April, we have 1,064,832 reported cases of COVID-19 in the U.S., and of those cases, 855,679 remain open. Again, citing Worldometers, but not just them, also the World Health Organization and the Centers for Disease Control, it appears that the recovery rate remains just over 96% for those not in a high-risk group. It is interesting to note that in just over the last month, according to Worldometers, recoveries in the United States have risen from 37 to 147,473. So again, you do the math. The slope of that line is nearly vertical, and it is the strongest of any of the COVID-19 trend lines on the Worldometer site. Elsewhere, this week, Gilead Sciences has been in the news because of 2 positive test results regarding the drug remdesivir as a treatment for COVID-19. In one study, the National Institute of Allergy and Infectious Diseases, or NIAID, concluded that the drug met the primary endpoint of the study and that patients recovered from COVID-19 much more quickly than those treated with a placebo. So again, as we've discussed before, the administration seems comfortable with moving forward with a progressive plan to reopen the economy in stages. As of this week, 8 states have reopened parts of their respective economies in stages, and it's being reported that as many as 23 more states may meet the mandates of Phase 1 of the administration's requirements for opening by mid-May. Well, all right, if that indeed materializes, then we could have the economies of as many as 32 states reopened to some degree 2 weeks from now. The hope is that toward the end of May, Even more states will meet the Phase 1 requirement, and the earlier states may have qualified for the second or even the third stage by June. If recent trends of recovery continue to accelerate and approaches of treatment are made more widely available, then it is conceivable that the United States economy could be largely open again by August. The markets have been moving higher since the 24th of March, in part because worst-case assumptions that were priced into the cathartic reaction to the disease in February may not be proving to be the results that we're observing. As we've discussed within conference calls, markets are discounting mechanisms, and in both directions. Now, the markets are in the process of repricing the assumptions made about 2.5 months ago in light of currently available information. Last week on our podcast, we talked about the studies from Stanford, USC, and Massachusetts that suggested actual rates of infection could possibly be 50% higher than were observed through testing, given the number of asymptomatic people tested in random samples who tested positive for antibodies. The conclusion being that herd immunity could be vastly higher than any model anticipated, and that remains a topic of debate this week, but the results of the studies seem to point to this conclusion. Lastly on this topic, Brian Westbury, and you've heard me cite him often. He is the chief economist with First Trust. He noted some very interesting statistics on Monday, the 27th of April. He said that the U.S. had tested 257,000 people per day between the 22nd of April and the 26th of April, versus 151,000 tests per day that were conducted over the 5 days prior to that, between the 17th and the 21st of April. It's interesting to note that over the last 5 days, where more tests were performed, that the rate of positive results stood at 12.8%, while the rate of positive tests just 5 days earlier, when fewer people were tested, stood at 18.1%. It would seem that the more that we test, the lower the percentage of positive results, and that is a very good recent trend. So in conclusion, how many times have you heard me say this? Stay focused on where we're going. As I've discussed with you before, you cannot react to a shocked market. If you try to do so, it generally creates a larger problem of having to battle the emotional aspects of when to return to the market. If your objectives remain in the intermediate to distant future, make this crisis work for you. Now, for what it's worth, since our last podcast, I have researched 16 other times during my 29-year career when markets reacted to acute shocks. I've suggested to you in the past that while the nature of the shock may be different, look, they're all different, the reaction to the shock typically follows a familiar pattern. Indeed, I found that 15 of the 16 shocked periods of time that I observed, markets reacted in essentially the same manner. We had a reaction, followed by capitulation, followed by a recovery. The only shock that did not follow that pattern was 9/11, and that was because it occurred on the heels of a Y2K-induced recession. This shocked market is at least so far following the same pattern as 15 of the last 16 recoveries. Patience is the key, and a focus on where we're going, not where we are. All right, look, lastly, we're having Zoom video meetings. We've had about 30 of these things so far, and they're great. In addition to our intercall conference call meetings, our individual phone meetings, while we're still waiting to have face-to-face meetings. We're leveraging all kinds of technology to remain in touch. Hopefully, we can get back to a normal course of business in the future, but in the meantime, while we're trying to feverishly stay in contact with all of you, never hesitate to reach out to us with your questions and needs of clarity. This podcast, virtual meeting technology, social media, and other channels are just part of a multifaceted approach that we've employed as an effort to lead in this crisis in a visible manner. Folks, I've told you this now for weeks. We are going to get through this together, and we're going to do it in a positive way, and of that much I can assure you. So again, thank you for your time listening to this podcast. We'll have another one for you next week. Stay safe, and we'll talk to you soon.
David Guttery and Brandon Guttery offer products and services using the following business names: Ameritas Investment Company, LLC, AIC, member FINRA, SIPC for securities and investments. Ameritas Advisory Services, AAS, for investment advisory services. AIC and AAS are not affiliated with Keystone Financial Group. Products and services are limited to residents of states where the representatives are registered. This is not an offer of securities in any jurisdiction, nor is it specifically directed to a resident of any jurisdiction. As with any security, request a prospectus from your representative. Read it carefully before you invest or send money. A representative will contact you to provide requested information. Representatives of AIC and AAS do not provide tax or legal advice. Please consult your tax advisor or attorney regarding your specific situation.